Hey everybody, welcome to this free edition of our Traders Weekly Roundup for the trading week ending February 7th, 2025. I'm Preston Brenton. Thanks for tuning in. Well, one thing we do know under the Trump administration is change is inevitable. Now, that change can be up or a down market, but it is inevitable. Probably more so than most. Let's just kind of take a look at where we've been and what I think could be coming up over the next month or two. If we take a look at this past week, we're going to see here a couple of weeks in a row, markets have been lower. They finished lower this week, although the S&P held up the best at 24 basis points underwater, but they were all just barely below the flat line for the week. Year to date, they're all still holding in the green. So far, we've had about 77% of the S&P 500 companies reporting Q4 results. Most of them have topped earnings estimates. Average growth rate of about 16.4%. Estimate going into earnings was 11.9. So that's helping keep the markets a little bit higher. And of these companies that have already reported, 63% have surpassed top line sales expectations. So all in all, bottom line is a little bit better. Top line is a little bit worse from 5 and 10-year averages. Okay. If we look at the economic data that came out this week, it kicked off on Monday with PMI data. It kind of showed U.S. factory activity expanded in January. That was the first time since 2022. But we did see services PMI decline a little bit from December into January. Still stayed in expansion territory, however. And then on Friday, we got the big jobs numbers. Everybody's watching that. They added 143,000 jobs in January. That was down from an upwardly revised reading of 307,000 in December. So it came in below economists' expectations. The economists were expecting 170,000 for the month of January, so it came in a little bit lower than that. Although we did see unemployment come down to 4% from 4.1%. Hang on 1 minute, guys. I'm going to put you guys on hold just 1 second. Let me just get something figured out here. Hang on a second here. Okay, I'm back with you. So anyway, all in all, slightly down week. If you look on the right-hand side of the screen in the upper right, you can see the PE ratio is still, in my mind, a lot more elevated than I'd like to see. It's at 22.43. Trailing 12 month is huge, 25.62. So we're going to see a little bit more of a pullback, I think, in the PE multiples, and that has a tendency to reduce the markets or at least put downward pressure on the markets. The yield, 10-year Treasury came in at 4.49, a little bit lower than even the prior week, but it's about 325 basis points higher than the dividend yield. Okay, and if you look at the S&P earnings yield, with the estimated earnings for this year, you can see the excuse me, guys. I got something stuck in my throat. Hang on 1 minute, guys. Okay, I'm back with you. So you can see here that the earnings yield is at 4.51. 10-year Treasury is at 4.49. Okay, so we've got a little bit of a discrepancy between the S&P and the Treasury, but not by much, by 2 basis points. So that's going to drive more money into the Treasury market, in the middle of the curve, yield curve. And we've got the VIX basically flat. It came in at 16.54, just slightly higher from the prior week. And the prior week was slightly higher from the week before. So volatility since Trump's been in office, as you would expect, has moved up just a little bit. Okay, and you can see the best performer for the week was real estate. Worst was discretionary. And then year to date, leading the way is financials, and also leading the way to the downside so far this year is technology, still in the red. Okay. So that's a little bit about what I'm seeing there in the U.S. markets. And of course, if we go across the pond, take a look at the European markets. You can see here everybody was in the green. Year to date, they're doing very well, even though Europe is having a hard time with their economy. You can see here they're doing fairly well. Everybody from Euro stocks, FTSE, CAC 40, DAX, all in the green for the week. Year to date, solid numbers. The worst performer is the FTSE, but that's still up 6.45%, right? We did get the Bank of England over in Great Britain. They cut their rates by quarter basis point, driving them down to 4.5%, saying they're making sufficient progress on their um, inflation and wage growth over there in Great Britain. But Bank of England, they basically have their forecast for the economic growth for their year down to 75 basis points, so almost no growth, almost like all of Europe. And according to Bank of England's latest projections, inflation set to stay above target there till 2027, and their target is like our Fed's target at 2%. Okay, so while they may cut their rates to deal with a slowing economy, they got to be very careful that they don't keep inflation higher for longer. And meanwhile, across the Eurozone, the other 19 countries that make up the ECB, we saw annual consumer price growth stayed above the ECB target for the third consecutive month in January, accelerating to 2.5% from 2.4% in December, although core inflation held at 2.7, you know. And services price inflation, which a lot of the Bank of England policymakers monitor very closely, came in at 3.9%, so still elevated, right? We did see factory orders in Germany jump 6.9% in December, and that was from a 5.4% drop in November. But they're still having a hard time over in Germany, which is the largest country that makes up the 19 countries of the ECB. So they're having really some issues, regardless of what the markets are showing. Sometimes the markets are ahead of the real economy by 6 months or so, and that would suggest that the real economy is finding a bottom and should be coming out. But we'll see how that plays itself out. Meanwhile, over in the Asian markets, you can see the Nikkei was down a little bit in the red. Year to date, it's also down. A lot of it is some hawkish comments coming out of the Bank of Japan, which is moving the yen a little bit stronger against the dollar. All right. And the yield on the 10-year Treasury rose to 1.28%. That's a high number for the 10-year Japanese government bond from prior weeks, 1.23%. So the markets are expecting continued interest rate moves higher, which is going to benefit the yen, which tends to hurt the Nikkei. Okay. And then in China, you can see there was an abbreviated trading week because they just came out of a week-long Lunar New Year holiday. And speaking of the Lunar New Year holiday, consumer spending was up about 18% from last year's Lunar New Year holiday. So that kind of counteracted some of the offset from Trump's decision to slap another 10% tariffs on China as well, right? So that's why China is in the green a little bit because of some of the consumer spending. Although year to date, China's in the red, as you can see. Hang Seng had a strong week and a strong year so far, all right? But despite all of these holiday sales coming out of China, there are a lot of other signals coming out of China that's showing that the broader economy is still very weak. Their PMI data slipped to 51 in January. That was from 52.2 in December. So they're still having a very weak time of it, even though consumers spent over the holiday season. Okay, their New Year's holiday season. So we'll see how all of that shapes up. What I want to do is shift you over to the charts. Let's take a look at the E-mini S&P 500 futures first. You can see we really haven't gone anywhere. It's going to take a couple of seconds to come up on your screen, but you're going to see that, the week ended down. Like I said, we had a really ugly day on Friday, down 56 points in the S&P futures. And you can see here, we're still holding above the 50 EMA. And you could see this range. I mean, we kicked off the year right over here at 59.38, and we moved up very quickly, although we did not make new all-time highs, right? Very close, but not quite. And now we're back down here, sitting at 60.50, right? So where do I think we're going to go from here? It's going to be a lot of chop. We got a lot of data coming out in the next couple of weeks. Economic data and inflation data. Next week we got key inflation data. And then the following week we get NVIDIA earnings. So these are enough to really get the market moving in a particular direction. But right now it's just a lot of chop. Okay. And I told our members going into this year to expect chop. And that's kind of what we're getting. Okay. If we take a look at the SPX equal weight, you can see the equal weight is pulling back to the 50 EMA. Okay. So we're not getting the kind of performance out of the MAG 7 that is typically reminiscent of the MAG 7. If we look at the FANG index, which is most of the MAG 7 except for a few, you can see here it's kind of pulled back a little bit. All right. And you can see that bearish divergence is what we call a poor man's bed because we've had multiple crosses in the MACD. And that suggests more downside, okay, in the FANG index. And of course, if we come over here and look, let's go back up here and look at the even Bitcoin is pulled back a pretty good little bit since the middle of this year. It had a high price in January 21st, and we've been moving back, and it's holding the 50 EMA right now. Right, I think that may break to the downside, and then that'll set it on a tizzy to possibly make new lows for 2025, even though we're, 4 or 5 weeks into the new year. And if we look at the Russell, you can see the Russell is still in the green for the year, just barely. It was in the red briefly on February 3rd, and then it moved back up, and now we're just kind of sitting in this tight range here below the 50 EMA. Okay, and then of course if we look at NASDAQ, which is, not doing as well. You can see we're above the 50 EMA, that red line, but just above our closing price of last year. So all in all, a lot of chop, not really a trending market. Every time we establish any kind of trend over a couple of green candles, then we revert back to red again. And if we look at the Dow actually had the most recent all-time high, right? It came in the end of January. And this one has had a nice trend to it. And the Dow industrials typically are the largest mega cap international companies. Average earnings the average earnings from offshore in the Dow is around 68%. Right, so that does show that they're getting some of the earnings offshore. Although a stronger dollar is going to start to hurt the Dow. Right, companies in the Dow, right, because they've got so much earnings coming offshore, and the stronger the dollar, then it's like adding a premium to your price for people over in Europe and Asian markets that are buying your stuff. If we look at the volatility skew, I just want to show you this here real quick. We're solidly in the green. This is comparing the February and March vol futures. Because we're in the green, the markets are not that concerned, even with this down move, ugly day on Friday. And that ugly day on Friday kind of came about because of a couple of different indicators hitting the screen. Consumer sentiment really came in not too well. And then, Trump talking about tariffs the following week, he's going to match tariffs of everybody else. So if other countries putting a tariff on the U.S. of 15%, he's going to tariff their stuff 15%. So that also aided in moving the markets lower on Friday. But even with all of that, we're still in what's called a contango situation with volatility skew. So it's normalized. And if we go out, look at the February-August spread, vol skew, still in the green, right? And then if we bring it in close and tight and look at the front month skew, comparing the VIX to the February futures, vol futures, we're still in the green. So we're in the green all across the board. So the markets, these strong earnings are really helping the market stay buoyant right now. If the earnings were not beating these expectations and analyst estimates, we would be in the red right now, at least 3 to 5%. But they are coming in strong. Forecasted forward guidance for most of them as an aggregated view is stronger than expected. So that's keeping the markets higher, okay? If we come down here and look at treasuries, let's take a look at bonds for a minute. You'll see they're down low on Friday, but they hit a high 2025 high price on February 7th. Right, up a little over 2.83%. Now remember, when bonds are going up, interest rates are going down. And if we take a look at the 10-year rates, you're going to see here the 10-year rates or actually we hit lows for the year, down 17.5 basis points from the close of last year. So net, you can see here, we're below that mythical 4.5%. We closed at 4.487 interest rate. We're just slightly on the 50 EMA right now, right? And you can see there is no divergence in this MACD, just not even that you could see. That does suggest that any move lower is not going to go much lower. And we're sandwiched right now between the 50 and the 200. Okay. I think longer term, the rates are going to move higher. And that's going to put some downward pressure on the U.S. equity markets. And members, we'll go through some of the stocks that I like with the given market environment that we're seeing right now. Let's look at currencies. Look at the dollar. You can see the dollar is, in the red for the year. We hit a high price on January 13th. It's a dollar index, actually, of 110. And now we're sitting here holding the 50 EMA. And if we look at the euro, which really drives the dollar index, you can see my target. We hit our target. It closed on my target level, right around 102 to the dollar. And now we're still in the red, though, right? So this right here seems to indicate the euro, because I got another target going out here into late this month into March. That would suggest that the dollar is going to get stronger and the euro is going to get weaker. That'll put more downward pressure generally on U.S. equities, especially those that are selling goods overseas, right? And as I said, the Dow is doing 68% of their sales overseas. The S&P has about 54, 55% of total sales volume of the S&P comes from offshore. So that gives you an idea of where we are with some of the major currencies. If we look at the yen, okay, look at the yen, all right? Remember what I told you guys, all right? Now, I've been bullish the yen. I told our members to get in on the yen, and here we go. It's just a good trade to get into. We're going to come up here. We're holding the 200 EMA. We beat the 50. It's just a solid trade. The markets are expecting the Bank of Japan to raise their rates again in another 3 months or so, 25 bips. That would move the yen even stronger. And this has a downward pressure effect on the Japanese index, the Nikkei. Okay. And then, of course, if we come down here and look at gold, gold is at record highs, right? Look at this. All-time high on Friday's close. We hit an intraday all-time high of 29.10. I think gold will see 3,000 this year. I am calling for some weakness in gold in April, May timeframe in the summer months, and then a stronger finish in the year. So the MACD is suggesting that you want to be long the gold right now, right? Just a nice run. Be careful in chasing so you can just kind of edge into it very slowly. And if we look at silver, you can see silver is also up, but it hasn't hit all-time highs. If I back it out a little bit, you can see all-time high for silver was made on October 22nd, right? And it was up 45.93% in 2024. But you can see where silver is here. Silver has been trailing gold dramatically. This would suggest silver is also going to move higher. This is an Elliott Wave 3, and you can see here my target for silver longer term is way up here around 36. That would suggest gold's going to move higher too. Near term, it could pull back or just soften a little bit in some profit taking, but I do believe longer term it's going to move higher. Oil is off the charts, but that would be off the charts to the downside, right? You could see where oil hit this high here. I told you guys that I don't see oil holding anywhere near the upper 70s or lower 80s for a period of time. And it just came right back down again. And I think oil is going to go lower, right? Remember, Trump's primary goal is to get the price of oil down, put more supply out there, right? Supply, demand, it's the old, elasticity of demand kind of concept. I've got a target for oil in the low 60s. All right, now it may take us a couple of months to get there, but that's what I got for oil. And then, of course, if we look at nat gas, that's just the opposite. Now, nat gas has come off the table also. This was where I was telling our members you might want to be shorting nat gas up in this area here, okay? Now it's come down to these levels down here. It's going to settle in down here a little bit. Remember, nat gas is more bullish than oil because we're looking at building more natural gas LNG terminals in the Gulf. We're not building, we're just turning them back on again and starting to ship nat gas out of Texas Gulf and Louisiana Gulf, Mississippi Gulf. LNG terminals over to Europe and to Asian markets. And Trump's opening that spigot. So that's going to continue to increase the demand for nat gas, which tends to drive prices higher in nat gas. Okay. So these are some of the quick and dirty things I wanted to go through with you on some of the major asset classes. Remember, it's this Sunday evening at 7 p.m. It'll be a short session because of the Super Bowl, but I just wanted to get through a couple of key topics that I want to talk about, as well as some potentially good stocks. All right, everybody, have a really great weekend. Enjoy the Super Bowl for you football fans out there. Members, I'll see you Sunday evening, 7 p.m. for our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. We're having fun this year. Ciao, everybody.